Back when I was a novice trader, I always wondered why some traders seemed to consistently succeed, while others struggled. I had read all recommended trading books and articles, watched countless YouTube videos, attended webinars, paid for signals, and even joined online forums looking for answers, but something was still missing. And the stats suggest that less than 10% of traders consistently make money. So, what separates them from the rest of us? I used to wonder. If you have ever looked at the charts and wondered why some traders seem to look at the same chart you're looking at, and at the end of the day, able to rake in cash while you take losses after losses and just can't catch a break, well, the secret had been hidden in plain sight all along. In this video, I'll reveal the 5 habits I discovered and had to abide to, which successful traders use to navigate the emotional currents and the volatility of the market. From learning to spot herd behavior, to mastering what trading is truly about, these habits will help you outsmart others and point you in the direction to become a master trader yourself. They are mental game changers that could take your trading from frustrating to flourishing. 1. Successful traders don't follow the crowd. Have you ever stood on a crowded subway platform waiting for the train? People jostle for seats, some glued to their phones, others scanning for the next available space. Now imagine you're a seasoned commuter. You've seen it all. You've seen the last-minute scrambles, the unnecessary pushing, and where the line cutters are. But you also know a secret. You've observed the subtle shifts, the unspoken patterns. You know where people tend to congregate, where the flow naturally directs them. Just like the experienced commuter, successful traders anticipate the movements, the sudden surges and unexpected pauses. They see fear causing people to crowd into safe investments, and they see greed pushing them towards risky ventures. But here's the twist. The seasoned commuter doesn't always fight the crowd. Sometimes they expertly navigate the flow, finding an advantageous position. Other times, they see the impending crush and strategically position themselves elsewhere. The key isn't to isolate yourself from the crowd, it's to understand its movements and use that knowledge to your advantage. To capitalize on the herd, identify what everyone's buying through news and social media. Use tools such as technical analysis to confirm buying pressure. However, don't blindly follow. Invest a small amount to ride the wave and set a sell target to avoid getting stuck when the crowd exits. Independent research is crucial. Don't just buy or sell because it's popular. Look for undervalued opportunities the herd might be missing. The herd can be wrong, so prioritize risk management and only invest what you can afford to lose. Use the herd as a clue, not a rule. Number 2. Successful traders don't day trade. The image of a successful trader is often portrayed as a fast-paced, adrenaline-fueled day trader glued to their screens, making split-second decisions to capitalize on fleeting market movements. However, reality paints a different picture. Many highly successful investors eschew day trading altogether. Instead, they are focusing on a long-term approach. Day trading thrives on short-term fluctuations, which can be driven by a multitude of factors, many of them unpredictable. News headlines, emotional reactions, and even random events can cause these fluctuations, making it difficult to consistently predict profitable trades. Successful traders, on the other hand, focus on identifying long-term trends based on fundamentals, economic outlooks, and cycles. These trends offer a more stable foundation for investment decisions. Compound interest, referred to as the eighth wonder of the world by Albert Einstein, is the magic formula of long-term trading success. It allows your returns to generate even more returns over time. The longer you hold an investment that grows steadily, the more powerful compounding becomes. Day trading, with its focus on short-term gains, misses out on this potent force. This isn't to say day trading has no place at all. Some traders have the temperament and resources to thrive in that fast-paced environment. But are you one of such traders? Number 3. Successful traders treat trading like a business. Forget the stereotype of the frantic trader glued to a screen, making impulsive decisions based on market noise. Successful traders operate more like CEOs, building a sustainable portfolio through a well-defined business approach. Imagine a business built on fleeting hunches and hot tips. It might work occasionally, but there's no guarantee of long-term stability. Successful traders, on the other hand, create a detailed trading plan. This plan acts as their company's constitution, outlining their investment goals, risk tolerance, and specific strategies. This plan serves as a constant reference point, guiding their decisions and preventing them from getting swept away by the emotional tides of the market. A seasoned business owner wouldn't panic sell their entire inventory just because sales are slow for a week. Successful traders exhibit similar discipline. They avoid the allure of quick profits or the urge to dump their holdings during temporary market downturns. They understand that short-term fluctuations are a natural part of the market cycle, just like a business experiences seasonal highs and lows. They focus on the long-term health of their companies, trusting their well-researched strategies to deliver results over time. Another important part of the taking trading like a business model is that it is not just about profit margins. A prudent business owner prioritizes calculated risks. Successful traders follow the same principle. They also manage their portfolio size wisely, not overexposing themselves to risk by investing heavily in an investment just because it is hot. This measured approach prevents catastrophic losses and ensures the long-term viability of their investment portfolio. 4. They maintain a healthy work-life balance. Imagine a world-class tennis player. Their entire day might revolve around practice, strategy sessions, and meticulously analyzing their opponent's moves. But what if they never took a break from the court? The stress, the constant focus, would eventually lead to burnout and hinder their performance. The same principle applies to successful traders. While they dedicate significant time and effort to studying the market and honing their strategies, they also understand the importance of maintaining a healthy work-life balance. Disconnecting is just as important as connecting the dots on the chart, and here is why. Mental sharpness and avoiding burnout. Trading can be a mentally draining endeavor. Constant analysis, information overload, and the pressure to make quick decisions can lead to fatigue and clouded judgment. Successful traders schedule breaks and pursue activities outside of trading. Whether it's hitting the gym, spending time in nature, or simply enjoying a relaxing time with their family or friends, these activities help them de-stress, recharge their mental batteries, and return to the market with renewed focus and clarity. Fresh perspectives and creativity. Being constantly immersed in the world of finance can lead to tunnel vision. Successful traders understand the value of stepping away and gaining fresh perspectives. Engaging in activities outside of trading allows them to explore new ideas, spark creativity, and potentially identify opportunities they might have missed while solely focused on the market. Emotional detachment and avoiding FOMO. The fear of missing out can be a powerful emotion in the fast-paced world of trading. Savvy traders recognize this and use their downtime to disconnect from the market chatter and emotional swings. This allows them to make rational decisions based on their strategy, not impulsive reactions fueled by FOMO. Trading is a marathon, not a sprint. Successful traders understand that a fulfilling life outside of the market contributes to their overall well-being and long-term success. Having a healthy balance between work and personal life reduces stress, fosters a positive mental state, and ultimately allows them to approach the market with a clear head and a sustainable approach. Just like the tennis player who needs time to rest and recover, successful traders prioritize activities outside of the market. This healthy detachment allows them to return to their trading pursuits with renewed focus, creativity, and emotional resilience, ultimately contributing to their long-term success. 5. They give their trades room to run. The tight stop mentality, where you try to minimize potential losses with hair-thin margins, can be tempting in the world of trading. However, successful traders often take a different approach. They embrace wider stops. Let's face it, the market is inherently unpredictable. News events, sudden shifts in sentiment, and even random fluctuations can cause short-term price swings. A wider stop acknowledges this reality, providing a buffer against these unexpected movements and preventing you from getting whipsawed out of a potentially profitable trade. Successful traders understand that short-term losses are inevitable. They focus on the bigger picture, their overall trading strategy and risk management plan. A wider stop allows them to stay invested in a trade that aligns with their strategy, even if it experiences some short-term noise. They prioritize managing their overall portfolio risk rather than getting fixated on minimizing losses on every single trade. While tight stops can be tempting because they offer the illusion of control. However, this can lead to impulsive micromanagement, constantly checking charts, and making emotional decisions based on minor price movements. Wider stops encourage discipline. They force you to trust your strategy and avoid tinkering with your positions based on every market whim. Wider stops don't mean recklessness. It is also important to remember that wider stops are not a free pass for carelessness. Successful traders carefully calibrate their stop-loss placement based on factors like market volatility, the specific trade setup, and their risk tolerance. They use wider stops strategically, not as an excuse to throw caution to the wind. By embracing wider stops, you can also navigate the market with a calculated composure with the understanding that short-term fluctuations are inevitable. This approach allows you to stay invested in promising trades and ultimately achieve your long-term financial goals. The world of trading can be a frenzy, constantly tempting you to react to every market movement. But these insights can equip you to shift your perspective. Just like successful traders don't blindly follow the herd, there's a crucial shift in perspective that separates winners from losers in the trading game. This might sound counterintuitive, but there's a hidden truth to the idea that winners are actually losers. But don't believe me? Watch this video to find out why. Don't forget to like, share, and subscribe to the channel if you like the video. Thanks for watching.